As of the final closing bell on Friday, November 28, Plug Power Inc. PLUG is trading at exactly $2.01 per share, having posted a modest intraday gain of 1.52% or roughly 3 cents, with after-hours trading adding another fraction of a percent to push the price to $2.02. To the casual observer scanning the tickers on a Fidelity mobile app or checking their Robinhood app, this looks like a quiet day for a beaten-down penny stock. The price action seems almost lethargic, hovering just above the psychological $2 barrier. The expectation from the retail hydrogen army is that this stock is currently in a holding pattern, waiting for the long-promised $1.66 billion loan guarantee from the Department of Energy to finally materialize and save the day. They see the green energy transition as inevitable and view Plug Power as the government's chosen champion, believing that a bailout is just a signature away. The reality, however, is a shocking pivot that most investors have not fully digested. The government savior narrative is effectively dead, or at least comatose. In a move that caught the market off guard, Plug Power recently announced it is suspending activities related to the Department of Energy loan guarantee, a tacit admission that with the changing political winds and the incoming administration, waiting for federal money is a suicide pact. But here is the twist that exceeds expectations. Instead of folding, Plug Power is executing a ruthless financial survival strategy that involves selling off its crown jewels, its power access, to the AI sector. The company is actively negotiating to sell electricity rights to data centers, potentially unlocking hundreds of millions in liquidity. We are no longer watching a pure-play hydrogen story. We are watching a distressed asset play, where a hydrogen company is morphing into a power broker for the insatiable energy needs of artificial intelligence. The tension here is not about whether hydrogen is the future. It is about whether Plug Power can cannibalize its own infrastructure fast enough to survive until it becomes profitable. To understand why this $2.01 price is so precarious, we have to look at the recent financing that rocked the shareholder base. Just days ago, Plug Power completed a $375 million convertible senior notes offering. The expectation when a company dilutes shareholders or adds debt is usually a crash. And indeed, the stock took a 19% hit initially. But the reality of this deal is that it bought them time. By netting approximately $399 million, they have retired high-cost debt and removed immediate lien encumbrances. For an investor engaging in online investment or using Schwab Intelligent Portfolios, this is a critical distinction. The company traded long-term dilution for short-term survival. They effectively pushed the bankruptcy clock back, giving the incoming CEO, Luis Crespo, a fighting chance to turn the ship around. This is no longer Andy Marsh's growth at all costs company. It is entering a phase of austere operational discipline. Let's dissect the AI pivot because it is the most misunderstood aspect of the current thesis. Plug Power holds valuable rights to electricity and infrastructure in places like New York and Texas. Originally, these were meant to power massive electrolyzers to make green hydrogen. But the reality of the market right now is that data centers, driven by the explosion in demand from companies like NVIDIA stock and Microsoft, are desperate for power. They need gigawatts, and they need them yesterday. Plug Power realized that its power interconnects might be worth more to a data center operator than the hydrogen business itself in the short term. Management has teased that monetizing these assets could generate over $275 million in non-dilutive capital. This is a brilliant, albeit desperate move. It essentially admits that the hydrogen timeline has pushed to the right, so they are pivoting to the one sector that has unlimited cash, big tech. For a trader using interactive broker stock trading tools, this correlation shift is vital. You are arguably buying a derivative of the AI power bottleneck trade disguised as a hydrogen penny stock. Despite the financial gymnastics, the operational reality on the ground is surprisingly robust, which adds another layer of complexity. The expectation is that because they are low on cash, the factories are silent. The reality is that the Georgia plant recently set a production record, churning out over 300 metric tons of liquid hydrogen in a single month. This proves that the technology, the actual electrolyzers and liquefaction trains, works. They are not selling vaporware. They're selling a product that is difficult to make. The issue has never been, can they make hydrogen? The issue has always been, can they make it without losing dollar bills on every kilogram? The Q3 earnings report showed a slight beat on EPS, coming in at a loss of -12 cents versus the expected -13 cents, but revenue missed the mark. This mixed signal is classic Plug Power, operational progress masked by financial murkiness. For those using SoFi Investing or Fidelity Mutual Funds to track the industrial sector, this dichotomy makes the stock a show-me story. The factories are humming, but the bank account is bleeding. The broader sector context is hostile. The green energy trade has been decimated by high interest rates and the political shift in Washington. The market expects the incoming Trump administration to be antagonistic toward green hydrogen subsidies, specifically the 45V tax credits that Plug Power's business model relies on. This is why the suspension of the DOE loan activities was a strategic necessity. They are decoupling their survival from the whims of Washington. If you are holding this stock in an individual brokerage account, you have to be comfortable with the idea that the subsidy tailwind is gone. You are now investing in a company that must compete on pure economics against cheap natural gas. This is a much harder game to win, but if they do win, the victory is far more sustainable. Institutional activity has been frantic. We have seen massive volume spikes, with days of 40 to 80 million shares trading hands. This indicates a changing of the guard. The ESG funds that bought the dream in 2020 are capitulating, selling out to distressed credit funds and deep value hedge funds that are betting on a turnaround. When you see this kind of turnover on your Fidelity trading platform or Robinhood crypto dashboard, where sentiment often overlaps, it usually signals a bottoming process, but a messy one. The volatility is extreme because the floor is zero, but the ceiling is a multi-bagger if they solve the cash burn problem. Let's look at the leadership transition. Andy Marsh has been the face of Plug Power for a decade, selling the hydrogen future with unmatched charisma. But the market has tired of promises. The transition to Jose Luis Crespo signals a shift from visionary to operator. Crespo's job is not to sell the dream. His job is to fix the margins. He needs to take those record production numbers from Georgia and translate them into positive gross margins. The expectation is that this transition will be rocky. The reality is that it might be the most bullish catalyst the stock has had in years. Investors want boring execution right now. They want to see costs cut, non-core assets sold, and a clear path to break even. If Crespo can deliver one boring profitable quarter, the stock could re-rate violently. Now, I want to hear from you. The decision to walk away from the DOE loan process is controversial. Some see it as giving up. Others see it as freeing the company from bureaucratic handcuffs. Comment below. Do you think suspending the DOE loan application was a mistake, or was it the smart move to pivot toward private funding and AI data center deals? I really want to know if you prefer government safety or private market agility. In the future outlook, we have to weigh the survival odds. Scenario A, the Phoenix rises. Plug Power successfully sells its power rights to a major hyperscaler for $300 million. The cash bridge allows them to ramp up the Tennessee and Louisiana plants. Margins flip positive in late 2026 as they stop buying expensive third-party hydrogen to fill orders. The stock reclaims the $5 level as the bankruptcy risk evaporates. Scenario B, the liquidity trap. The data center deals fall through or face regulatory hurdles. The cash from the convertible notes runs out in 12 months. With the DOE window closed and the stock price too low for efficient equity raises, they are forced into a restructuring or a fire sale of assets. The stock drifts below $1 and faces delisting. Scenario C, the acquisition. A major oil and gas major, like BP or Shell, or an industrial giant, like Honeywell, looking to hedge their bets on the energy transition, acquires Plug Power for its technology and tax losses. This would likely happen at a premium to today's price, but a fraction of the all-time highs. The technicals on the chart are ugly, but showing signs of exhaustion. The stock has been making lower lows for 2 years. However, the RSI, Relative Strength Index, is showing bullish divergence, meaning the price is making new lows, but the momentum is not. For the technical traders using investing sites to draw lines, this is often a precursor to a reversal. The $1.80 to $2 zone has acted as a floor where buyers step in. As long as it holds this level, the bear trap scenario is in place.